Hi class, welcome to Lecture 2.1 Working Capital Management. You could also call this Short-Term Financial Planning. As you may recall from our very first lecture, working capital management is one of the three major financial management decisions. The capital budgeting, which was long-term investments or projects that maybe the business wants to take on. Capital structure decisions, which have to do with how do we pay for our assets, meaning how do we structure our debt and our equity to pay for all of our assets. So it's a debt versus equity decision. And then what today's lecture is about is working capital management. How do we manage those day-to-day or short-term decision processes for the firm? Now, as I discussed earlier, a lot of these decisions have to do with how do we interact with our suppliers and with our customers? Do we offer discounts if we pay on time or if our customers pay on time? And what kind of situation will we have with our short-term credit? Would we like to get out, small loans from banks? Would we like to put stuff on credit cards? Would we like to pay in cash? A lot of these decisions have to do with cash management. Now, we won't discuss everything in Chapter 15. In fact, only a few key concepts from Chapter 15 will be covered for the exam. There are a lot more concepts covered for Quiz 4, but as far as the exam, there's only three major key concepts. First, I would like you to understand sources and uses of cash. Next, I'd also like you to be very familiar with both the operating cycle and the cash cycle. And finally, I want you to understand why these cycles are important. Don't just memorize the equations. Why would I need to know this information down the road to make corporate finance decisions? One of the most basic reasons that you would want to understand operating and cash cycles is to make sure that you don't go bankrupt, right? Bankruptcy is one of the major issues that small businesses face, especially within those first 2 years. And if you don't have adequate financial resources, bankruptcy becomes a very real possibility. Now, as far as big firms are concerned, bankruptcy is not usually their number one priority. There's a lot of other, smaller issues that they want to make sure that they get nailed down. Sales projections from marketing, cost numbers from accounting, inventory requirements from operations. All of these will play a major role in the operating and cash cycles for a firm. I would like to begin by talking about sources and uses of cash. And I suppose the first question to ask is, why do we care about cash? Well, one of the major issues for any financial operating officer for a company is to make sure that they understand cash flows and that there is enough cash available to cover current liabilities. This obviously prevents companies from facing liquidation or reorganization structures under bankruptcy, but it also helps improve the bottom line. So it's not just the worst case scenario here. Proper management and use of cash is going to make the company run far more efficiently and give it a higher profit margin, which is one of the main goals for a company. Now, to truly understand cash flow, we first need to identify whether a specific action item is a source of cash or a use of cash, and these are obviously opposites. For example, a source of cash would be to increase long-term debt. A use of cash would be to decrease long-term debt. So you are getting money from a loan, and that obviously would create a source of cash, or you are paying back that loan, which would take cash or use cash. If you look at the third point there on both slides, you will see increased current liabilities and then decreased current liabilities on the other side for uses of cash. So it works the same way with a short-term loan as it does with a long-term loan. Obviously, if you get a loan, that's going to give you cash. If you're paying it off, that's going to use cash. The same thing is true with equity. If you issue shares of stock, then you're going to raise capital, so you're going to get money by increasing equity. And then be careful to understand what decreasing equity means. This is an issue that comes up on number 5 on your test guide, and it's when a company decides to buy shares back. And although this may seem like a rare event, this has actually been a very common event since the last Great Recession of 2007 through the early part of 2009. The reason for this is interest rates are very low right now, so companies are using low interest rates or extra cash on their books to buy back shares and hopefully buy those back at a cheaper rate, at a good rate, so that down the road when the share price goes up, they made a good deal for their investors. So once again, you can increase equity or decrease equity by either issuing shares or buying those shares back. Now on the other side of the balance sheet, you have your assets. So you can raise money, a source of cash, by decreasing your assets, whether they're current assets or fixed assets, by selling them, right? So if you get rid of inventory, that's going to give you some cash. If you get rid of a plant, a piece of property, equipment, that's all going to give you cash. On the other hand, if you buy more inventory, if you buy a plant, if you buy property, if you buy equipment, that's all going to use cash. So once again, you can see that these are, sources and uses are exact opposites. Now there are a couple of items listed on balance sheets that are not as easy to figure out. For example, accounts payable and accounts receivable sometimes get students confused. So let me ask this question. If a company's account payables increases by $1,000, is this a use of cash or is this a source of cash? Well, if you remember, account payables are considered a short-term liability, so it's very much like getting a loan, and this would be kind of like borrowing cash from a supplier instead of from a bank. So this would obviously be a source of cash. On the flip side, what if account receivables increases by $1,000? Well, then this would be a use of cash, because in this situation, the company itself is loaning out money to its customers. Now let's look at a problem number 4 from your test guide as an example. Now, number 4 from your test guide is a problem that you will very likely see on the exam. In fact, you'll see almost every problem that is on the test guide on the exam. Number 4 reads, the Roadkill restaurant has the following current account values for the year. These accounts represent a net blank of cash for the year and the amount of blank. So the two blanks that would need to be filled in, the first one is either going to be a source or use of cash, and the second one is going to be a dollar amount. Now, they've given you 3 items: inventory, accounts receivable, and accounts payable. To figure out if there's going to be an overall source or use of cash, you need to find out what changed for each one of these items from a cash perspective. So if you find the difference between each one of those items from beginning and ending positions, and then total up all 3 of those differences, that is the answer we are looking for. So, looking at the answers, you will see that we have a net source of cash in the amount of $8,339. How do we get to these answers? The first thing you would do is you're going to subtract the beginning inventory from the ending inventory. In other words, just put a minus sign between beginning and ending for all 3 items, and you will find that we end up with negative $1,800 and for inventory. Now think about that. If inventory goes up, that means that we have purchased more inventory. So that is obviously a use of cash. Now, the second step is to look at accounts receivable. It went from $25,500 to $20,822. So that position went down by $4,678. So you may ask, why then is there a positive sign? Well, I'm using the positive signs as to represent sources of cash. The negative signs represent a use of cash. So the first step with inventory was a use of cash. The second step now represents a source of cash. We have collected $4,678 from our customers, and so that is cash that we now have. On the flip side, in step 3, you will see accounts payable. Accounts payable went from $16,940 up to $22,401. Now, it's on the other side of the balance sheet, so the rules are actually opposite for accounts payable. In this case, the $5,461 difference or increase in accounts payable is actually also a source of cash. That is because that is like a line of credit extended by our suppliers. So we have gotten cash from both our customers and our suppliers, and we have spent a little bit of money on increasing our inventory. Overall, this is a net source of cash in the amount of $8,339. So make sure you get the signs right. The signs have to do with whether or not it's a use, which would be a negative sign, or a source, which is a positive sign of cash. And then you add those and total it up, and that's how you solve a problem like number 4. Now, I'm not going to do number 5 during the lecture, but it is very similar to number 4. Make sure you remember that common stock can both be issued and bought back. So there's your friendly, helpful hint for number 5 on the test guide. Switching gears to our second key concept of this lecture is the operating cycle. The operating cycle is a period in time that starts when you purchase inventory and ends when you receive cash from a customer from selling the inventory. In other words, it starts by receiving inventory, and then along the process you will sell the inventory, and eventually you will collect the receivables from the customer. Because of this, the operating cycle can be broken into 2 parts. The first is the inventory period, where you purchase the inventory and then you sell it. And the second is the accounts receivable period, which begins after you've sold the inventory and ends when you have collected the receivables or the cash for the purchase from the customer. So pay special attention to the terms inventory period, also known as the time inventory sits on the shelf, or sometimes specifically called the average holding period. So inventory period is also the same thing as the average holding period. And then there's the accounts receivable period, which is the time it takes to collect on receivables, and this is sometimes also called the average collection period. So regardless of, if you call it inventory period or average holding period, or if you call it accounts receivable period or average collection period, you add both these together and you get the operating cycle. Now, if we take a look at this next slide about the operating cycle equations, the first bullet point there is just a rehash of the last slide. If you look more closely at the inventory period and the accounts receivable period bullet points, you will see that these are simply ratios that we have learned previously for exam 1. In other words, not everything that you're learning here is new. You get to use some of the information that you learned in the previous for the previous exam for this exam as well. As you may recall, the exact equation for the inventory period equals 365, or the number of days in a year, divided by the inventory turnover. And the inventory turnover is nothing more than the cost of goods sold divided by average inventory. Now, if you look at accounts receivable period, it's a similar equations. You have 365 divided by the receivables turnover, and that receivables turnover is your credit sales divided by average accounts receivable. Now let's look at the cash cycle since we've just gone over the equations for the operating cycle. Now the cash cycle is obviously going to track the cash. So this is the time from the moment of payment for inventory, so given cash over, a use of cash, to the receipt from the sale of the inventory, meaning getting cash back from the customer. So that would be a source of cash. In other words, the cash cycle is the moment that cash was paid for inventory to the moment when cash was received. So the cash cycle really answers the question, how long do we finance inventory and receivables? Now, mathematically calculating the cash cycle is pretty easy. It has similar but different equations as to the operating cycle. Mathematically, the cash cycle equals the operating cycle minus the accounts payable period. Now, like the other two periods that we talked about before, which were the inventory period and the accounts receivable period, the accounts payable period is just simply a ratio equation that you've seen before when studying for exam 1. Accounts payable period equals 365 divided by the payables turnover. And that payables turnover equals the cost of goods sold divided by average accounts payable. There's really nothing strange about these equations except for one important caveat, which I've highlighted red on this slide for a very important reason. You can figure out the cash cycle once you know the operating cycle and the accounts payable period, but you cannot use the cash cycle and the accounts payable period to figure out the operating cycle. The reason for this is simple. The cash cycle is what's left over from the operating cycle after the accounts payable period. So just remember to not mathematically calculate the operating cycle using the cash cycle and the accounts payable period. Although it looks like that's, an okay thing to do from an algebraic standpoint by just rearranging the equation. You want to find the operating cycle specifically by looking and using the operating cycle equation, which is the inventory period plus the accounts receivable period. Now, I know that last statement might seem somewhat confusing, so let me show you a graph that shows you both cycles together so that I might explain, in a illustrative manner what is all involved in both the operating cycle and the cash cycle. The operating cycle in this figure or this graph is in blue. And what you will see is it has two different periods. It starts when the inventory is purchased and it ends when the inventory is sold, or at least the first period, which is called the inventory period, and then you start the accounts receivable period, which ends when the cash is received. Now, once you know the entire operating cycle, you can then figure out the accounts payable period and subtract it from the operating cycle to get the cash cycle. So the accounts payable period is from the moment inventory is purchased to the moment that cash is paid for inventory. From that second that you've paid for the inventory and given over cash, you need some kind of financing, or you're in some kind of cash limbo because you've given money but you haven't gotten money back yet. So until you get that money back, that cash received, that is called the cash cycle, and is really important for firms to know ways and to try to minimize that cash cycle so that they don't have to extend credit with banks or use credit cards or use other forms of costly financing to cover that cash cycle. So conceptually, there are some main points that I really want you to take about the accounts receivable period and the accounts payable period. The first item that I really want you to make sure you understand is that we are only talking about current assets and current liabilities. So this is some very short-term decision making here, and that's why working capital management is sometimes referred to as short-term financial planning. So the current assets that we would be talking about will include cash or marketable securities, inventory, and accounts receivables. The second point is that cash management is extremely important, especially for small firms just starting out from a bankruptcy standpoint. But once again, every firm needs to properly or efficiently manage receivables and payables to increase their bottom line. In other words, if a company can work at more favorable terms with its customers or its suppliers without hurting its sales, this is pretty much a win for the company, because this is not only going to reduce the cash cycle but also reduce the need for expensive financing. Now, there's also a couple of main points when talking about the inventory period. As I previously mentioned, one of the current assets that we are looking at is inventory. Inventory is a unique current asset and an essential one, especially for a lot of companies that don't have just-in-time delivery set up for their inventory systems. And the reason I mention that is because the cost associated with holding inventory can be extremely high. When you think about holding inventory, you're not only having to warehouse this inventory and have people move this inventory back and forth and keep it organized, you also have to keep items from becoming broken, lost, or stolen. You also have to consider that the longer an item sits on your shelves, the less likely it is going to be sold, or that you're going to be able to get your money back from selling that item because it may have fallen out of favor, or it may have also become obsolete. In other words, if a company can decrease its inventory without hurting its sales, it's going to increase its bottom line because the investment in inventory must be financed. Let me repeat that again. An investment in inventory must be financed. This financing is going to really increase the cash cycle and the interest payments on debt. And obviously, this can have a negative effect on the bottom line, or in other words, reduce your profits. Now that we've talked about the conceptual issues with the components of the operating cycle and the cash cycle, let's look at it from a mathematical perspective. This slide shows you the different equations for a problem involving both the operating cycle and the cash cycle. And this is very much like the problem number 1 on your test guide. So using the information from the previous slide, you then will fill in, plug and chug the numbers as needed to calculate the inventory period and the receivables period. If you add those two together, you will get the operating cycle. So in this case, the inventory period was 111 days. Receivables period was 57 days. You add those together, you get 168 days. And then moving on from the operating cycle to the cash cycle, you'd first compute the accounts payable period using the information from the previous slide, or I said 2 slides ago. Once you get that information, you can then subtract the accounts payable period from the operating cycle to get the cash cycle. So as you may recall from the previous slide, the operating cycle was 168 days. Here we have calculated the accounts payable period is 39 days, so 168 minus 39 is 129 days, which means, using the definition of the cash cycle, that inventory and receivables must be financed for 129 days. As the chief financial officer for a firm, I'd love to see that number go down, and I would be very upset if that number went up. So now that we've looked at a math problem, it's time for you to try one on your own. Suppose your average inventory is $10,000, your average receivables balance is $9,000, and your average payables balance is $4,000. Net sales are $100,000 and cost of goods sold is $50,000. What are the operating cycle and cash cycle? Now we'll give you a moment here to try to work these problems out yourself using the same formulas that we just discussed in the previous slides. As you can see on the quick quiz solution slide here, the inventory period is 73 days, the collection period or receivables period is 33 days. You add those two together, you'd get 106 days for their operating cycle. The payables period is 29 days. If you subtract that from the operating cycle, you get 77 days for the cash cycle. Congratulations, you now know the math for both the operating cycle and the cash cycle, which is very important. Now that we understand the basic math, let's try to use this knowledge to develop a better understanding of the operating cycle and the cash cycle by moving on to some problems in the test guide. So the first problem I want to take a look at is problem number 2 on your test guide, because we've pretty much already done 2 problems that look like problem number 1. Carter's currently has a 197-day operating cycle. The company is concentrating on increasing its inventory turnover rate from 8.1 to 9.7 times, meaning they want it to go up. What will the firm's new operating cycle be if it can effectively make this change? So the first thing you have to do is understand the equation. Remember, the operating cycle is the inventory period plus the accounts receivable period. So if the inventory period goes up, the operating cycle goes up. If the accounts receivable period goes up, the operating cycle goes up. So both of those periods have a positive or direct correlation with the operating cycle. So an increase in inventory period will have an equal increase in the operating cycle. Vice versa is true as well. A decrease in the inventory period will have an equal decrease in the operating cycle. So the first thing we want to do is figure out the inventory periods, both the old one and the new one. The old one is 365 divided by 8.1, which is 45.06 days. The new one, now that they've changed to 9.7 times for inventory turnover, is 365 divided by 9.7, which is 37.63 days. So the inventory period here has gone down or been reduced by 7.43 days. So if the inventory period goes down by 7.43 days, then the operating cycle must go down by 7.43 days. So looking at the new operating cycle, you could calculate that by taking the old operating cycle and subtracting 7.43 days, which is how we get 197 minus 7.43 equal to 189.57 days. Moving on to a different kind of conceptual problem for operating cash cycles, let's take a look at number 3. The green fiddle increased its operating cycle from 149 days to 166 days, while the cash cycle decreased by 4 days. How have these changes affected the accounts payable period? Now, the first thing I want to point out to you is that we can use the cash cycle equation to find both the cash cycle and the accounts payable period. Just don't use it, remember the important note, don't use it to find the operating cycle. So it can be rearranged as I do here in step 1 to find the accounts payable period. So the accounts payable period equals the operating cycle minus the cash cycle. So in this case, if we know that the operating cycle is going to increase from 149 days to 166 days, we can find the difference there and find that that increase is 17 days. Also, if the cash cycle is going to decrease by 4 days, then we can find the change in the accounts payable period by just simply summing up the changes in the operating cycle and the cash cycle, or in this case actually finding the difference in those changes, since the accounts payable period equals the operating cycle minus the cash cycle. So the change in, and that's what that delta or that triangle means, the change in the accounts payable period is 17 for the operating cycle minus a negative 4 for the cash cycle. So notice there's a minus minus, which from an algebraic perspective means plus, right? So 17 minus minus 4, or minus a negative 4, equals 17 plus 4, or 21 days. So the accounts payable period has increased by 21 days. Now moving on to our final problem for this lecture. This problem is going to look at a almost purely conceptual problem. That it's math related, but you're not going to actually have to do any math, computations to answer this problem. Suppose that Martin Metal Products changes its policy and starts requiring all of its customers to pay within 30 days rather than 15 days that it currently allows. Which one of the following will result from this change? Well, we know that the operating cycle is the accounts receivable period plus the inventory period. Okay, and I know that looks like IR, but that's an IP there. So operating cycle equals IP for inventory period plus accounts receivable period. This means that an increase in the accounts receivable period, which is what this problem is talking about, will create an increase of the exact same amount in the operating cycle. Now, we also know that the operating cycle has a direct and positive correlation on the cash cycle. So by increasing the operating cycle, we will also increase the cash cycle. So on the exam, you can have several answer choices here, but only one of them is going to say both the operating cycle and the cash cycle would both go up. You might have an answer choice that might say something like the operating cycle goes up and the cash cycle stays the same, or the operating cycle goes up and the cash cycle goes down. or the operating cycle goes down and the cash cycle goes up, or they both go down, and then finally one of the choices will say they both go up, and that would be the right answer in this situation. Hopefully, you will notice too that the problem on the exam will not be exactly the same. How could I change this? Well, this problem talks about a change in the accounts receivable period. I could easily talk about a change in the inventory period or the accounts payable period, and that change could be a decrease instead of an increase. So you need to fully understand the relationships between the different periods and the different cycles. This concludes Lecture 2.1. If you have any questions, please let me know.